Okay, so tonight we're going to talk about earned income tax credit. That's one of the biggest credits that our clients look forward to getting on their tax returns. Some of you may have heard of it before, some of you may have not, but it is a very big deal, requires a lot of due diligence, and it's really, really probably one of the most important credits that we file on our tax returns. So by the end of this chapter, you'll be able to tell if the taxpayer meets the earned income credit rules that apply to all taxpayers, taxpayers with children, and taxpayers without children. You'll know where and how to report the taxpayer's earned income tax credit, and you'll be able to describe the rules for a taxpayer who was denied or disallowed the earned income tax credit in a prior year but wants to claim it this year. Now, a lot of these slides, if you've already done the modules in the online tech school, they're going to look very familiar. I'm not going to read all of the slides out loud. The purpose of these trainings is to kind of give you some real world experience, give you a chance to ask questions. It's not to replace the online module in any way, shape, or form. It's just kind of to clarify things that may come across as confusing. And I will say that the earned income credit is one of the most complicated credits that you were going to deal with on a regular basis. Thankfully, our software will walk you through all of these questions. You don't have to make the decision if they qualify or not. You just need to be able to read and understand the questions, know how to answer the questions, and understand what the questions are asking you. And in that case, the software will tell you whether or not they qualify. Now, you do have to be able to determine, looking at their income, if they have a low enough income and they are not qualifying for earned income credit, you need to go back and review the questions in the software to see if you answered one of them wrong, because there is one question specifically, if you answer it the incorrect way, it will deny the taxpayer's ability to get the earned income credit. So that's one of the biggest mistakes I see on earned income credit, is people not double checking their work and making sure that everyone's getting all the credits they are supposed to have. Okay, so this chart here kind of summarizes up all the rules for the earned income credit. So there's the rules for everyone. So no matter who you are, you have to meet these rules to be able to qualify for the earned income credit. Your adjusted gross income must be, and these are last year's numbers, 2021 numbers. They're increased for 2022 tax year. But we obviously didn't have those numbers when these lesson plans were created. So for 2021, your adjusted gross income had to be less than 50,162 or 55,952 if married filing jointly with 3 or more children. And there's a misconception out there with a lot of taxpayers that really came to fruition last year with all of the child tax credit money and the advanced child tax credit payments. People were under the impression they could only claim 3 of their children because earned income credit was based on 3 children maximum. So last year, all of a sudden, people had a lot more children than they had claimed in prior years. And we had to correct that misconception for a lot of people. Taxpayers should always claim all of the children that they have the legal right to claim. But surprisingly, or maybe not so surprisingly, people were allowing relatives to claim their children because they thought they could only claim the 3. So did a lot of educating last tax season. So basically, back to the rules for everyone. If your income as a married couple exceeded $55,952 and you had at least 3 children, then you may qualify for earned income credit. If you had income of $15,570 or $21,370 for married filing jointly, but didn't have any kids, once your income exceeded that, you could not get that earned income credit. It is exclusively for what they consider low income taxpayers. Okay, so to get the biggest earned income credit, you have to have children. The credit is kind of like, I call it a plateau shaped credit. If your income's low, your earned income credit's low, but it goes up as your income goes up till you reach the maximum credit you can get. And then as your income continues to go up, then the credit starts to go down. So I always say it's like a plateau shape. If you have a qualifying child, your child must meet the relationship age, residency, and joint return test, which is very similar to the dependents. Your child cannot be used by more than one person to claim the earned income credit. And you, the taxpayer, cannot be a qualifying child of another person. We're going to go into detail on all of those in just a few more slides. And then rules if you do not have a qualifying child. So for 2021, the rules were a little different, but these rules are applicable for 2022. You must be at least age 25 and you have to be under age 65. You still can't be a dependent of another person. You can't be a qualifying child of another person, and you must have lived in the United States for more than half of the year. Okay, so again, rules for all taxpayers. There's an AGI limit. You must have a valid Social Security number. Married filing jointly citizens. If you're married, you have to file jointly. You must be a U.S. citizen or a resident alien. Cannot file Form 2555, which is foreign earned income exclusion. You have an investment income limit and you must have earned income. So if your only income was from unemployment or Social Security or retirement funds, you do not qualify for the earned income credit. Okay, so we already kind of went over the maximum AGI limit, so the maximum the taxpayers could earn. Okay, so here's the rules about Social Security numbers, and these are pretty important. We actually had a client come in this summer who had their taxes prepared by another preparer, and they still hadn't gotten their refunds, and some of their refunds had been eliminated, and they weren't sure why. And we offer to do look back services. So we'll look back at prior returns and see if they were prepared correctly. And this valid Social Security number became, well, that was the reason they hadn't gotten their refunds or their refunds had been reduced. So to claim the earned income credit, the taxpayer and spouse must have a valid Social Security number by the due date of their return, including extensions. All children that qualify for the earned income tax credit must also have a Social Security number issued by the due date of the taxpayer's return. Children who were born or passed away during the tax year can still be a qualifying child for the earned income credit, but the taxpayer has to do some additional steps of attaching a copy of the birth certificate, death certificate, and hospital records showing a live birth. And their Social Security card cannot say not valid for employment. And that goes for any of their qualifying children as well. So what happened with the taxpayers this summer is the husband was not a U.S. citizen. He was not here legally. Once he got legal and got a real Social Security number, they went back and filed their tax returns because he had been working here illegally. But he had W-2s with a fictitious Social Security numbers on them. So the other preparer had allowed them to file back the number of years that we can go back to file tax returns and still get a refund, and allowed them to claim earned income credit. Obviously, their software didn't catch that the Social Security number wasn't valid then, or the preparer wasn't aware of the rule. But because they didn't have the Social Security numbers, they couldn't go backwards and get those credits. They could only get them for tax years going forward. Okay, so here is an example of the Social Security number situation. Joe and Velma have valid Social Security numbers. Their qualifying child has an ATIN, which is an adoption taxpayer identification number. They expect that they would be getting a Social Security number by the end of the year. And it finally arrived on November 7th, and they filed their tax return on November 20th. Can Joe and Velma claim the earned income credit with Nate as their qualifying child? Well, the due date for extensions is October the 15th, most tax years. And since he did not get his Social Security number until November 7th, he would not be allowed to be a qualifying child for earned income tax credit. Okay, So again, I mentioned earlier, married couples must file a joint return in order to qualify for the earned income tax credit. But like a lot of things, there's always an exception to the rule. If a married taxpayer is not filing jointly with their legal spouse, they can get earned income tax credit only if both of the following apply. They had to have a qualifying child that lived with them for more than half the year, and they did not live with their spouse at any time during the last 6 months of the year, or they are legally separated according to state law under a written separation agreement or decree of separate maintenance, and they did not live with their spouse the last half of the year or at the end of the tax year. Now, Michigan does not have legal separation. I've heard that they do, but we've not ever seen anything legally and binding like a divorce decree would be, or any kind of court order. But if we get clients that come in from a state that does have legal separation, which I think California might be one of them, we would have to honor the legal separation. But in most cases, a lot of people haven't lived with their spouse the last half of the year, and so it becomes a non-issue. But occasionally we do have people who come in and they're still living with their spouses. They just don't want to file jointly because of any kind of issues. Like the spouse might have back child support, or the spouse might have back taxes, or the spouses just keep all of their finances separate. Obviously, we have to educate and let our tax customers know the rules and what they could be missing out on. But we can't ever force anyone to file a tax return with their spouse just to get the earned income credit. All right, another example. Don and Jerry are married taxpayers who filed separate returns. They have 2 dependent daughters. They lived together until Jerry and the girls moved out of the house on May 15th of the tax year. Jerry established her own home for herself and the girls by renting an apartment. Jerry did not live with Don during the last 6 months of the year. She is the custodial parent. She paid more than half the cost of keeping up their home. She's eligible to file as head of household. Can she claim the EITC? And then here it says if Jerry does not meet the head of household requirements, she may still qualify to claim the EITC using married filing separate as her filing status. And that's because, again, she did not live with Don the last 6 months of the year. Now, the whole key part of whether she can file head of household compared to whether she's required to file married filing separate is did she pay more than half the cost of maintaining her home? Okay, so let's talk about US citizens and resident aliens. A non-resident alien may be able to claim the earned income tax credit if both of the following are true. They are married to a US citizen or a resident alien and file married filing jointly, and they choose to be treated as a US resident. But again, they must have a valid social security number in order to be able to file for the earned income tax credit. Excuse me, it's very dry in here. Okay, so I talked about the Form 2555 restriction or 2555, the foreign earned income form. If the taxpayer is filing this form with their tax return, they are automatically not eligible to file for earned income tax credit. Doesn't matter if their income meets the threshold, that automatically disqualifies them from getting the credit. Okay, investment income limit. So the purpose of this is to keep people from working the bare minimum, but living off of inheritance or like a trust fund and trying to get the earned income credit. So the taxpayer cannot get the EITC unless their income and their investment income is greater than the limit. They cannot get the earned income credit if their income is greater than the limit shown on the EITC in a nutshell table, which I will show you here in a minute. What is investment income? It's taxable interest, it's ordinary dividend income, it's tax exempt interest, and it's capital gain net income. Okay, so let me look at this again. The limit for the investment income is if they have more than $10,000 in investment income, they don't qualify for the earned income credit. Okay, earned income. So the taxpayer or spouse in a married filing joint return must have earned income to claim the credit. Only one spouse has to have earned income. So if one spouse stays home and takes care of the kids and the other one works, that's okay. They just have to have some earned income in order to qualify for the credit. Earned income is any taxable employee pay and the net of self-employment income. So reported on line 1 of 1040 and then schedule 1, line 3. Types of taxable or earned income would be wages, salaries, tips, other taxable employee pay. One thing you probably never thought of, taxable scholarships and fellowship grants that are reported on Form W-2. So again, unearned income doesn't count toward the earned income credit. So that investment income we just talked about, pensions and annuities, Social Security benefits, unemployment compensation, alimony, child support, workers' comp, and public assistance benefits. So if they aren't working, they're not going to get this credit. Okay, so military personnel have a couple special rules. Military personnel can elect to include their non-taxable combat pay as earned income to help qualify for the earned income tax credit. But they can't say, oh, I only want to claim part of it. They can't use it to get to the threshold to get the maximum credit. They have to include all of it or none of it. Okay, so let's talk about the most common situation that we have with earned income credit. People who have children. So when a taxpayer meets the rules for all taxpayers, so their income is below the thresholds, they're US citizens, they have Social Security numbers, their investment income doesn't exceed the threshold, then they have additional rules with kids. They have the qualifying child test. Again, the dependent cannot be used on more than one tax return for earned income credit, and the taxpayer themselves cannot be a qualifying child. Okay, so qualifying child test. Remember, there has to be a relationship, the age of the child. So the child has to be under age 19 or under age 24 if still a student. Or if they're over age 24, they must be permanently and totally disabled. The joint return test, which means your dependent isn't filing a joint return with anyone other than to get a refund of taxes paid. And the child has to have lived with you for more than half of the calendar year. But the support test isn't part of the requirements for earned income tax credit, which is kind of interesting. Okay, so here's an example. Jan's son, Michael, 17 years old, is single and lived with Jan all year. Mike works part-time. He earned $5,897, which he uses to pay his own support. His total support for the year was $9,953. So basically that means that's how much it took for him to, live for the year: housing, food, clothing, shelter, all the good stuff. Well, maybe not the good stuff, but the necessary stuff. Michael paid more than half of his own support, disqualifying him as a dependent for his mother. Because again, as a dependent, you have to provide more than half of the taxpayer's support. But because he's under age 19 or under age 24, if he's still a student, which he probably should be, he does pass the relationship, age, residency, and joint return test. So his mom can still claim him as an earned income tax credit child, but not as a dependent. So again, our software will walk you through this. It's just, I want you to know that this exists. It can be very confusing. Okay, we already talked about Social Security numbers. The child must have a Social Security number unless the child was born and died during the tax year. And again, special rules for those kids. Qualifying child cannot be used more than once. So sometimes a child could be the qualifying child for more than one individual, but only one person, again, can claim that child for benefits. So back in chapter 2, we have tiebreaker rules about who gets to claim a child as a dependent. If one of the taxpayers is a parent, that parent is allowed to claim the child. If more than one taxpayer is the parent, the person with who the child lived the longest is allowed to claim the child. If the child lived with both parents equally, so this would be like an unmarried couple. If the child lived with both parents an equal amount of time, the parent with a higher adjusted gross income is allowed to claim them. And if none of the taxpayers are the parent of the child, then the taxpayer with the highest AGI is allowed to claim the child as a qualifying child. However, if any parent qualifies to claim the child but does not, the non-parent taxpayer's AGI must be higher than the AGIs of all parents who qualify to claim the child. Again, confusing, but just memorize the rules. You know, parents have first right to claim their child, and the parent with the highest income is the one who gets to claim the child. That's the most common situations. I'm going to check. My computer keeps dinging, so I'm going to check and see if there was questions real quick. Nope, I think it's just people joining in and to the meeting. Okay, so some exceptions, because again, like I said earlier, there's always exceptions to the standard rule. A non-custodial parent, so under the rules for divorced or separated parents, and oftentimes this is written into divorce decrees, mom and dad are going to alternate claiming the child every other year. So non-custodial parents year to claim the child. The custodial parent can still use their child to qualify for head of household and for the earned income tax credit. The non-custodial parent can only use the child for the child tax credit. So again, it's one of those things, it comes up from time to time. I actually didn't even know this rule applied until my cousin pointed it out to me one year. And I was like, oh my goodness, how did I miss this? But I mean, it's one of those things that until someone tells you about it or you run into the situation, you might not know that in this case, one child can be used for two different people for two different credits. Okay, so here's a good example. David and his brother Varel and their niece Iman lived together all year. Iman is the qualifying child of both David and Varel. However, only one of them can have her as a qualifying child for the earned income credit and the other tax benefits for which she is the qualifying child. No one else claims Iman. David's earned income and AGI are $70,000. So he qualifies to claim Iman as a dependent and for the child tax credit, but his income is too high for earned income credit. Varel's earned income and AGI are $40,000. So he qualifies to claim Iman as a dependent for the child tax credit and earned income tax credit. If they both try to claim her, who would the IRS allow to claim her under the tax breaker rules? Okay, so it would be David because he had the higher AGI than Varel. However, he could choose not to claim her, which would then allow Varel to claim Iman and use her as an earned income tax credit qualifying child. So there's always a rule around a rule. Here's just a few other examples. Again, these are going to be in your online tax school modules, so I'm not going to read them all to you, but I wanted you to be aware that there's all sorts of different situations. Okay, taxpayer cannot be a qualifying child. So this situation comes into play. Well, here, I'll just read this example to you because it's a perfect example. Dana, 20, and her son Ty, aged 1, live with Dana's parents, Patrick and Kelly, all year. Dana is a single full-time student who earned $7,546 from her part-time job. She has no other income. Patrick and Kelly's only income is wages of $90,415. Because Dana meets the relationship, age, residency, and joint return test for her parents, she is their qualifying child. Even though she's 20, she can still be claimed as a dependent for her parents. But can Dana claim her son, Ty, for earned income credit? No, she can't, because she is still a qualifying child of her parents. And even though they're not eligible to claim earned income tax credit, she can't get it because, again, she's their dependent qualifying child. The taxpayer is not a qualifying child of another individual if that individual is not required to file a tax return, and either of the following is true for the individual. They do not file a tax return, or they file a tax return only to get a refund of income tax withheld or estimated taxes they paid. Example of that: been taking care of her daughter Jill since birth. Josie's 18 years old, Jill is 2. Josie and Warren are both single. Who's Warren? Warren is Josie's father. He's 61 years old. Josie had earned $6,873 and provided more than half of her own support, and she has no other income. Warren's only income is wages of $1,745 and a pension of $7,741 with the $19 of federal income tax withheld. Under what conditions can Josie or Warren claim the earned income tax credit? So Josie meets the relationship age, residency, and joint return test for Warren, but Warren is not required to and is not going to file a tax return. So that means Josie is not Warren's qualifying child, which means she can claim the earned income tax credit if she meets all of the other requirements, which it looks like she does. She's got a qualifying child. She's got earned income. And if she has a Social Security number and her child does, then she could claim it. Now, if Warren filed a return only to get a refund of that $18 of tax withheld, then Josie still would not be Warren's qualifying child, and she could still claim the earned income credit if she meets all the other requirements. If Warren had filed and claimed the earned income tax credit, then Josie would be Warren's qualifying child, and she could not claim the earned income credit. So there's a lot of little caveats to this, but again, our software walks us right through it. So you don't have to worry about it. You just need to be aware of it and understand it. Okay, so the rules for individuals without a qualifying child. If they meet the rules for all taxpayers, but they don't have a child, then the income and age restrictions really come into play. Again, there's the age requirement. They have to be over age 25 and under age 65. They cannot be a dependent of another taxpayer. They cannot be a qualifying child, and they have to live in the U.S. Now, if they do have a qualifying child, but they do not claim the earned income credit with a child, they can still claim the earned income credit without a qualifying child if they meet all of the requirements. The taxpayer chooses not to claim the child does not have a valid Social Security number, or the taxpayer cannot claim the child because of the tiebreaker rules. So here's an example. Grandparents' income is less than the EITC limit without a qualifying child. Stephen is 35, his daughter is 12, and they lived with his father, Adrian, 60, all year. Stephen's earned income and AGI are $9,000. Adrian's earned income and AGI are $12,000. Nyaja's mother did not live with Stephen or Nyaja. Stephen and Adrian both claim Nyaja as their qualifying child. Under the tax tiebreaker rules, which person will the IRS allow to claim Nyaja? So Stephen, as the child's parent, will be the only one allowed to claim his daughter as a qualifying child. The IRS will not allow Adrian's EITC claim. However, Adrian can then claim earned income tax credit under the rules for someone without a qualifying child if he meets all of the other requirements, because his earned income and AGI are less than the limit for taxpayers without a qualifying child. Okay, so the age requirement. So for 2021, there was special rules that were different than they are for all the other tax years. Last year only, the taxpayer only had to be age 19 or older, and there was no maximum age for the credit. Like right now, if you hit once you hit age 65, you can't get earned income credit unless you have a child. You had to be 24 or older if you were a student to claim earned income credit last year, and 18 if they were a qualified former foster youth or a qualified homeless person. So again, those are last year's rules. Just be aware that 2021 had a lot of different things going on because of the coronavirus relief packages that had been passed. But 2022, we're back to normal with age limits, income limits, etc. Okay, again, taxpayer cannot be a dependent. So if anybody can claim that taxpayer on their taxes, they cannot claim earned income tax credit on their own tax return. This is true even if the other individual does not actually claim the taxpayer as a dependent on their tax return. So in this case, it might be your 26-year-old son lives in your home. He works part-time and you support him. You provide more than half of his support. So while he is, and he's not, let's say he's disabled, but you decide not to claim him because it's not worth the $500 that you get for him or whatever. So when he files his tax return, because he could have been claimed as a dependent on his parents' return, he would not qualify for earned income credit. Okay, some additional rules. You cannot be a qualifying child. We've talked about that over and over again. You must live in the United States for more than half of the year. And it means the actual United States, not any of the US territories like Puerto Rico or Guam or the Virgin Islands. And it can be anywhere that they live on a regular basis. So even someone who is in a homeless shelter, as long as they were here in the United States living for at least 6 months, they can qualify for the earned income credit. And US military personnel who are stationed outside the US are considered to be living in the US for that duty period. Okay, so how do we calculate and claim the credit? The software will put all of the figures into the earned income credit worksheet and calculate the credit out that way. But you should just be familiar with it, and you should be familiar with how to read the earned income credit tax tables or the chart for calculating the credit. Again, I apologize, I'm so dry. Okay, so where do you claim the credit? You have to fill out Schedule EIC, and the information on that schedule will then transfer to Form 1040. All right, so this is what the forms look like. They ask you a bunch of questions, and again, as you answer these in the software, it fills out the form for us. And then this is the Schedule EIC, Earned Income Tax Credit Calculation. And then the next slide shows you kind of an overview of what the earned income credit tables look like. See how it says income 31,400, but less than 31,450. You follow that across. This is for married filing, or this is for head of household. And you find out what the credit is based on no kids, 1 kid, 2 kids, or 3 kids. So as you can see, if you're head of household with no kids, your income is over 31,000, you're not getting a credit. But with 1 child, you get 1,651, 2 kids, 3,373, and 3 kids, 4,113. Now, earned income credit is a refundable credit, so they get this all back as a refund if they don't have any tax liability. And this is what the Schedule EIC looks like. It has the list of the 3 children, if you have 3 children, their names, social security numbers, year they were born, because they need to meet the age requirements. So If someone files a tax return and claimed earned income credit when they weren't supposed to, the IRS is going to punish them for that. They not only take away the credit in the year that they found to have calculated it or claimed it incorrectly, they are also penalized for future tax years. If it was just done, well, we'll go over that here in a second. But if they want to claim it in the next tax year and they had a qualifying child, and if it was because of a math error, like they just forgot to claim some income or they did something correctly that was minor, then they have to fill out the form 8862 and file it with their tax return in order to claim that earned income credit. Okay, so if it was denied due to reckless or intentional disregard, they cannot claim the tax credit for the next 2 tax years. If it was done due to fraud, they can't claim it for the next 10 years. And for those years, you don't even file Form 8862. They're just not allowed to claim it. It's a best practice to always ask all of your taxpayers or all your clients, did you get any letters from the IRS asking or notifying you that you do not qualify for the earned income credit? Nobody ever says yes, and then their tax return gets rejected because they were not allowed to claim earned income tax credit. So it's one of those things, you look back at it, you ask them some additional questions that if that happens to determine, did they claim a child they weren't supposed to, or was it because they forgot to claim some of their income? And then we can proceed by putting this form in the system and getting them that earned income credit. Okay, here's an example. The IRS denied Tamron her earned income credit due to reckless or intentional disregard of the rules. So again, she can't claim it for the next 2 years. And if they had denied it because she had been fraudulently filing it, like she made up income to qualify for it, then she can't file for 10 years. So it'd be 2022 through 2031. Okay, so this is what the form looks like. Again, the computer creates this form for us. We just want you to be aware of what it looks like. Okay, so for earned income credit, we learned that there's special rules that apply in order to qualify it for the credit. There's rules that all taxpayers have to meet. There's rules for people with children, and there's rules for people without children. We talked about the rules that with qualifying children. We talked about how they have to have social security numbers before the due date of the tax return, including the extensions. We talked about the qualifying child test, and we talked about the rules for tiebreakers to determine who's allowed to claim those childs for those benefits. A taxpayer without a qualifying child may qualify for the earned income credit if they meet all of the following: the age requirement, not being a dependent of another taxpayer, and not being a qualifying child of another taxpayer, and they have to meet the residency requirement. Taxpayers with qualifying children must complete Schedule EIC and attach it to the tax return. And again, if it was ever denied or reduced, then they have to file Form 8862 information to claim certain refundable credits after disallowance and e-file that with the tax return. And then, of course, for 2022, the age and earned income limits will decrease on the people filing without a qualifying child, and the age requirement will become back into place where they must be between age 25 and under age 65. And for the last 2 tax years, we were able to use 2019's earned income to calculate the earned income credit. And that is because so many people were on unemployment, they didn't have any earned income. But that has went away. So again, for 2022, it's strictly based on what they earned during that calendar year. Okay, so that is it on chapter 6. Let me see if there was any questions. If you have any questions, go ahead and type them in the chat. I need to run and grab a glass of water because I just drank all my water. Then I'll be back and we'll start on chapter 7, and I will answer any questions that are typed into the chat while I'm gone. So I'll be right back. Okay, I'm back. Thanks, Kathy. Let me see. That doesn't look like there's any questions, so let me get chapter 7 up and going. Okay, chapter 7, dividends. So not quite as much, not as heavy as earned income credit, equally important though. So we will jump into this. Let me see. Okay, so what will we learn in chapter 7, interest and dividends? We will learn how to apply a correct tax treatment to the amounts that are reported on Form 1099 INT or Form 1099 DIV, dividends and distributions. The type of income that's generally reported on these forms is taxable interest, ordinary dividends, qualified dividends, and capital gain distributions. We will figure out when a taxpayer is required to file Schedule B, interest and ordinary dividends, and how to calculate the right tax rate depending on whether it's a capital gain or if it's just ordinary income. Sorry, I'm trying to find my screen I had before. Okay. All right, interest income. What is interest income? It is money that's lent to you. It's money that you lent to a financial institution, a corporation, a government, or an individual. So most people are used to seeing interest income back when our savings accounts actually gave us something more than 0.01% interest. You also get interest income from CDs, certificates of deposit at banks, though even the interest on those is pretty low right now. The bank is only required to send you a 1099 INT if they pay you $10 or more of interest. So a lot of people aren't seeing them so much anymore. A lot of times they're online on the bank's website. They don't even mail them to you anymore. Sometimes they're included with your last bank statement of the year or your first bank statement of the year. And people don't even realize they're there because they don't have printed statements anymore. So even though they don't have to send it to you unless you have $10, you still have to report it if it exceeds $1 because everything's taxable. You can also get tax exempt interest. So taxable interest, again, is generated when the taxpayer deposits money into a financial institution. Generally, we're going to talk about other ways you can get taxable interest as well. Tax exempt interest is when you lend money to a government by purchasing interest-bearing bonds. For example, the road construction projects have been financed recently with road bonds, and that is money that the state of Michigan has borrowed from taxpayers who bought bonds to help pay for the roads. So you earn interest on lending the government that money. So constructive receipt, that is considered, your interest becomes taxable income when you constructively have it. So when that money is deposited into your bank account or when it's made available to you. So an example here is that Jake earned interest income, the bank credited on December 31st. He didn't withdraw the money from his bank account until January 2nd. He's still considered to have earned that income on December 31st in that tax year. So it would be taxable to him for example 2022. All right, types of interest. So we already kind of talked about this a little bit. It's a periodic payment from your taxpayer account, interest in your savings account. It can also be when you buy bonds to help the government fund projects. Also, credit unions and mutual savings banks, they refer to their monthly payments as dividends, but that's technically really interest. Okay, so I said that there was other ways to get taxable interest than just your bank account. So if you lend your brother money to start a company, so he can be self-employed, any payments he pays you that are above the principal interest, you'll have to claim that as taxable interest on your tax return. If you invest in U.S. savings bonds and other treasury obligations, they are interest bearing and that is taxable income. A lot of people were surprised the last couple years when your tax return, your tax refund is late getting sent back to you. The IRS or the state has to pay you interest on the delayed refund. So a lot of people were getting 1099 INTs from the IRS and didn't realize you're going to have to pay taxes on the extra money that the government gave them. What a great gift. So other forms of taxable interest. So interest does not necessarily have to be money. When, the banks have been having these big promotions where we'll give you $100 if you open a new account with us with a beginning deposit of $1,000. That $100 is a gift for opening your account. It is considered taxable interest. Now, I remember years ago, Independent Bank used to have a different gift of the month for opening new accounts. The value of those gifts could be considered interest income. Foreign source interest income. So if you've got a bank account over in France, you would have to claim that interest income on your tax return. Okay, let's talk about government bonds, treasury bills, notes, etc. The interest for those is taxable for federal purposes, but is not taxable by any state. So Michigan has income tax, as you are all probably aware. There are a handful of states that do not tax any income, which would be a blessing. But you don't have to pay Michigan tax on your treasury bonds. So how do treasury bills work? They're issued at discounted prices, and the difference between the discounted price you paid and the face value at maturity is the interest portion. And you don't claim that interest until the T-bill is paid out at maturity. So as it's growing, you don't have to do anything with it. It's when it's actually reached its maturity. So 4 weeks, 13 weeks, 26 weeks, or 52 weeks. Treasury notes have a maturity period greater than 1 year and range up to 10 years. And then treasury bonds have maturity periods that are more than 10 years. Some of them are 30 years. I actually just found out last year that my mom had bought savings bonds for me and my brothers, and I found them in a drawer in her bedroom. And they were actually, one of them had matured. So that was a pleasant surprise for me because it was mine that had matured. It was just one of those interesting things that, 25 years ago, 30 years ago, my mom's like, oh, I'll buy this $50 treasury bond. And now it's worth like $108 or something crazy. And I don't have to report that as interest income until the year I cash it out. Okay, so there's lots of different types of bonds. We're not going to get into that today. I will say people have been talking a lot about the Series I bond lately. So if you're looking for something to invest your money into, those have been paying out some crazy good interest. But again, you have to wait 30 years to get all of that interest earned, to get the full amount of the interest earned. Okay, Series H and HH bonds are taxable in the year that you receive them. Series EE, Series E, and Series I bonds, you get to choose. You either can postpone reporting of the interest until the year that you cash it out, or you can report the increase in the redemption value as interest each year. Seems kind of complicated to me to keep track of that, but some people are very organized. But whatever method you choose, you have to use it for all of your bonds. You can't say this one I'm doing this way and this one I'm doing that way. It's one way or no way. I mean, you got to pick one way or the other. Okay, interest on savings bonds issued in the names of co-owners is generally taxable to the co-owner who purchased the bond. If they file separate returns and they live in a community property state, then they each have to file their half of the bond interest. And where does this go on the tax return? So again, we talked about taxable interest and non-taxable or tax exempt interest. Here on the 1040, you can see that tax exempt interest goes on line 2A and taxable interest goes on line 2B. So even though you don't have to pay taxes on it, you do have to tell the government about it. And we already talked about the fact that you can lend money to your state or local government to pay for different projects. Sometimes schools will have bonds that they put out to build additions or to upgrade technology. I already talked about Michigan's road bonds, and these are exempt from both federal and state taxes in most cases. Now, I did actually learn something today that the state of Michigan, if you have a muni bond from another state, Michigan will tax you on that interest. So that was interesting. Again, not taxable for federal tax purposes. And this is the screen right here that made me look up that rule to see how does Michigan handle that. So Michigan bonds, they don't tax you on, but they will tax you if you're helping out Indiana. Okay, so IRAs, individual retirement arrangements, is a tax deferred retirement planning account. So you do not include any interest that's earned inside that arrangement until the funds are distributed. And interest on a Roth IRA is never taxable because those contributions are made with after-tax dollars. That's why a lot of people like to invest in Roth, because it grows tax-free and they can take it out in retirement and not have to pay any taxes on it. Okay, so I already mentioned that when you have interest income, it's reported to you on Form 1099 INT or a substitute statement. And again, they have to send that to you if you have interest greater than $10. But how they send it to you may not mean you're getting it in the mail. It could come to you electronically. They are required to send that out to you by January 31st of the following year. So any interest you earn through December 31st, 2022, you should receive that 1099 INT no later than, or has to be mailed no later than January the 31st. And again, you have to report all your interest income even if you did not receive a statement. So here it just talks about where the type of interest is reported on your tax return. This is what a 1099 INT statement looks like. Box 1 is always interest income. Even on the substitute statements, the box numbers have to match up even if it's not printed on the exact form. And it always is going to carry to the 1040 in the same spots. Okay, so let's talk about dividend income. Dividend income is money that a company pays you if you were a shareholder. And the dividend is them sharing a portion of their profits with the owners of the company. A dividend can be money, it can be additional stock, or it can be property paid to the shareholders of a corporation. Some amounts are called dividends, but are actually interest income. We talked about that again. Credit unions are infamous for doing this. It's not really a dividend, it's interest if it's from a credit union. Interest earned by a regulated investment company, also called a mutual fund, is distributed as a dividend. Okay, so there are two types of dividends, ordinary dividends and qualified dividends. Sorry, I have to get another drink. Ordinary dividends are the most common type of distribution from a corporation. Again, they're paid out of the earnings and profits of the company and are ordinary income to the taxpayer, not capital gain income. Ordinary dividends are taxed at ordinary tax rates that apply to all other income like wages and retirement funds, private retirement funds like from your 401k. They're all taxed at your regular tax rate. What is a qualified dividend? Qualified dividends, it says these are ordinary dividends paid by a domestic U.S. corporation or qualified foreign corporation. Let's see if we can figure out what the difference is on that. course, I don't have that handy right here. So I think there's certain companies that have been that are qualified. I'm not sure where you get the listing for that, but the dividend statement you get, the 1099 dividend, will tell you this isn't something you have to determine. It's reported to you and it's reported to the IRS. And qualified dividends are taxed at capital gains rates, which are 0%, which is the one I want to be in, 15% or 20%. So in most cases, those are a reduced rate compared to your ordinary taxable income rates. And what category you fall in depends on your filing status and your income. So to qualify for a zero capital gains rate, if you're single, your income cannot exceed $40,400. Married filing joint or qualified widower, $80,800. Head of household, $54,100. And married filing separate, $40,400. Now, people who pay the most on capital gains, the 20% rate, they have very large incomes. A single filer, their income would have to exceed $445,851. Now, I would like to be in that tax bracket just for the income, but not for the taxes. Okay, so mutual funds. Mutual funds are a pool of money from many, many investors. This is usually what your retirement accounts are invested in is in mutual funds. They help to minimize risk and diversify your portfolio. So a mutual fund will often be made up of some things that are not risky at all and some things that are more risky, some foreign stocks. So it kind of divides your risk across a greater span. So you're not going to have the massive ups and downs of being dependent on just one company. So the fund owns asset, like I said, the shares of stock. The investor owns shares in the fund. So a common type of mutual fund is a money market fund, or like I said, what your 401ks are invested in are usually different types of mutual funds. So taxable dividends from a mutual fund can come from U.S. obligations that are not taxable on a state return. Some states do not tax any of the dividends paid to the taxpayer by a mutual fund. And other states tax the dividends in less than a certain percentage of mutual funds, unless the interest comes from direct obligations of the U.S. government. Capital gain distributions. One way that a mutual fund makes money is for its investors to sell assets at a gain. So they're constantly trying to buy low and sell high. If the asset was held by the mutual fund for greater than 1 year, the nature of the income is a capital gain. Capital gain distributions are taxed at long-term capital gain rates. And that means they are taxed at the same reduced capital gain rates as qualified dividends. Again, you won't have to figure out if it's a capital gain distribution. That's going to be reported to you on the 1099 DIV. Okay, non-dividend distributions. You'll see these on the 1099 dividend. It says it's a dividend that's not paid out of the earnings and profits of a corporation. A non-taxable distribution is also called a return of capital. It is a return of the taxpayer's investment in the stock of the company. They are considered fully or partially taxable as dividends only because the paying corporation's current and accumulated earnings and profits are less than the distributions. Non-dividend distributions do not include tax-free stock dividends or distributions exchanged for stock in liquidation or redemptions. So again, you don't have to worry about figuring this out. It's going to be on the form. You just need to know what it is, just to have an idea in case someone asks you any questions. And this is what the 1099 dividend statement looks like. You will see a lot of substitute 1099 dividends. They come as part of brokerage statements. But again, the box numbers are going to match up even if it's not printed on a form that looks like this. Okay, dividend income. Again, the payers are required to issue a 1099 DIV or substitute statement if the dividends paid are greater than or equal to $10. but you do have to report all dividends on Form 1040. So you will see broker statements come through that have dividend income for less than $1. Less than 40 or 49 cents and lower rounds to zero for tax purposes. So if you see one that's for 51 cents, they now have $1 of dividend income. And again, our program will do that for you. You type it in exactly as it appears on the document. It will transfer it to the right spots at the right amounts. All right, Schedule B. Taxpayer needs to include Schedule B, interest and ordinary dividends, with their tax return if the following circumstances apply. If they have taxable interest income greater than $1,500, if they have, or if they're excluding any U.S. savings bond interest, if they have ordinary dividends greater than $1,500, do they have seller financed mortgage interest income? Does the person hold a land contract? Are they selling a house to someone who couldn't get a bank loan? They have to report that on their tax return, not only as interest income, but also as capital gains income, depending on if it was a residence they lived in or if it was an investment property they purchased for the purpose of selling it later. That's another complex topic. We'll talk about it again some other time, more in depth, but you just need to be aware that those are taxable events. Do they have a foreign bank account? And do they have any other special rules that apply? So all those rules is how when they do need to file Schedule B, but they don't have to file Schedule B if their total taxable interest plus their ordinary dividends is greater than $1,500. But if their individual interest or dividends is not. So example, Ben has taxable interest of $800 and ordinary dividends of $770, which equals $1,570. Does he need to file a Schedule B with his tax return? Nope, he doesn't, because his dividends or his interest, neither one are more than $1,500 individually. And he didn't meet any of the other criteria for having to file it. Again, our tax software will produce these forms if necessary. This is what the Schedule B looks like. It has two parts. Part one is for reporting interest income, and that carries on to line 2B of the 1040, page 1. And part two of the Schedule B is for reporting ordinary dividends, and that carries on to line 3B of the 1040. And here's an example of a brokerage statement. It has the 1099 dividend listed on it with the information that you need: ordinary dividends, qualified dividends, capital gain distributions. And again, see the lines match up with what would have been the boxes on the 1099 DIV form. And down at the bottom, it has the substitute 1099 interest statement as well, with the different types of interest that we talked about. And here's how that carries on to the Schedule B. Because he had more than $1,500 in interest, he does have to file Schedule B. And it does report the dividends, even though it was less than $1,500, because he's already having a Schedule B included on his tax return. And there's where the numbers carry to from the statements that we previously viewed. Okay, so capital gains tax. Again, qualified dividends and capital gains distributions are taxed at reduced capital gains rates of 0, 15, or 20%. And use the qualified dividends and capital gain worksheet, not workshop, in the Form 1040 instructions to calculate out the tax on it when Schedule D is not filed or when otherwise instructed. Again, the beautiful part of software is we don't have to do these by hand anymore. Okay, so capital gains sheet, capital gains tax. The worksheet again calculates your total income that was included. It will figure out your tax using both regular ordinary tax rates and your capital gains rates. And the taxpayer gets to use whichever rate results in the lower amount of tax. Here's just an example. Nora Jackson's filing status is single. She has income that includes $40,200 of wages. She also has dividends as shown on her 1099 DIV. She's got $3,000 of ordinary and qualified dividends and $222 in capital gains distributions. See how that carries on to her 1040. And this is what it looks like on her worksheet for calculating out the taxes. So her total tax on all of her taxable income is $3,122. All right, so to summarize what we learned about interest and dividends, most taxpayers' investment income comes from taxable interest, tax-exempt interest, dividend income, and capital gains income. Interest income includes all interest the taxpayer receives or is credited to their taxpayer account. Taxable interest is going to be reported on 1099 INT. We complete Schedule B, interest and ordinary dividends, if required, if their interest income is greater than $1,500. And again, we talked about how dividends from credit unions are actually interest, they're not dividends. Ordinary dividends are the most common type of distribution. They are taxed at ordinary income rates. And some stocks, they have a dividend reinvestment plan that lets the investor choose to use the dividends to buy more shares of stocks instead of receiving the cash dividends. Even if the dividends are used to buy more stock, the taxpayer must still report them as dividend income. You report complete Schedule B if their dividend income is greater than $1,500. Taxpayers are subject to backup withholding if they fail to provide the payer of their interest or dividends with their taxpayer identification number. Interest from U.S. savings bonds are exempt from state and local taxes, but is considered taxable interest on the federal return. Tax-exempt interest on Form 1040, but you do not include it in taxable income. And if the taxpayer is not required to file Form 8949, sales and other dispositions of capital assets, or Schedule D, capital gains and losses, they can report their capital gains right directly on Form 1040. And there's special holding periods that are applied to ordinary dividends that allow them to be considered qualified dividends and qualifying for the reduced capital gain rates, which are again 0, 15, or 20% based on your income for the year. And you use the worksheet in order to calculate out the tax. So that is it for Chapter 7, Dividend and Interest Income. Let me check and see if you guys had any questions. I know I covered a lot of stuff really quick. If you have any questions, feel free to unmute yourself and ask. Oh, I see someone typing. Looks like it's Rochelle. You're welcome, Rochelle. If you guys have any questions or you think of anything else, you can reach us at taxschool@mijhtaxpro.com, or you can reach me directly. My last name's a little bit harder to spell out, but you just reach out to me through Tax School. I'm happy to respond to that. I work on Mondays and Wednesdays generally in the office, though I do check email occasionally from home. So thank you all so much. We look forward to meeting you guys in person very soon, and have a great rest of your night.